Good morning, everyone. Welcome to Windsor Brokers Live Daily Market Outlook. Today is Friday, 2nd of November 2012. We are at the end of the week. Of course, we have the most important release today, the U.S. Non-farm payrolls, as well as unemployment rate that is highly watched and expected. Most of the markets are focusing now on today's release. The action during the night showed the Asian shares advancing to their highest levels in nearly 2 weeks, with risk appetite returning on signs that the trend of global recovery is stabilizing, particularly in the United States and China, with the positive U.S. Private sector employment and consumer confidence reports released yesterday that drove the dollar higher, while the yen retreated as demand for safe haven assets weakened. They said the U.S. non-farm payrolls data are due at 12:30 GMT, and this is the key market event. 125,000 new jobs is forecasted for today. A slight improvement from 114,000 of the previous month release, but along with the other data that came, especially yesterday's ones from states that came quite unexpectedly better than expected, see some positive tone in the U.S. economy's recovery. As said, the jobless unemployment rate will probably rise in October as employers stepped up hiring only slightly, and underscoring President Obama's vulnerability in the next week's presidential election. As forecasted, and I mentioned earlier, employers likely added approximately 125,000 jobs to their payrolls last month, with the unemployment rate expected to come at 7.9%. Economists expect a key focus in the neck and neck race for the White House to tick up by to give a slight, in case of course, positive release today's, to give a slight support for the President Obama. The Labor Department's closely watched report, which will be released today at 12:30, will be the last major report card on the economy before the Tuesday's presidential elections, which pits President Obama against Republican candidate Mitt Romney. If the forecasts are correct and the economists are right, it will show the 8th straight month of lackluster job growth, a worrisome trend that would likely reinforce the Federal Reserve's resolve to keep easy money policies in place until the economy shows increased pace of recovery. From today's, just briefly to mention that euro remains under pressure this morning following a reversal of, actually following the weakness of from the beginning of Asian session, testing the levels at support levels, important support levels at 129, 128.85. Also, sterling is lower against the dollar, hits a fresh low at the end of Asian session at 160.84, while dollar yen remains positive, ticking higher and approaching our initial target and previous peak at 80.37. Also, dollar Swiss, after finding ground at 92.75, remains in steady recovery. 93.63 seen so far in the early hours of European session, ahead of very important and strong barrier at 93.85 and 94.00, 200 days moving average, and the round figure psychological resistance. Commodities are at the back foot for today after crude was pushed higher yesterday to the fresh high at 87.37 following unexpected draw in the U.S. crude stocks. However, the gains were short-lived as the oil price is back below $87 per barrel support, and currently trending at 86.53 with the quite negative tone seen on the hourly chart, seeing potential for more corrective easing. This is still seen corrective, but in any case, the crude oil is poised to register the first weekly gain in the quite a long period after a following period of heavy losses on a descent from 100.72 recent high, regardless of today's action. As said, commodities are raising their recent gains as gold fails to clear 1726. This was the previous high, and we mentioned in our yesterday's written analysis that a break above 1720 as initial barrier requires a clearance of 1726. This was the previous high of 31st of October in order to attract some higher levels. However, failure to do so has seen a fresh and steep reversal from 1726.85, yesterday's high, that dipped as low as 1706, makes basically the downside again more vulnerable, and bringing focus down to the 1700 strong psychological support, where the gold is currently attempting to build the base. Of course, more clues about all the movements we will have in a couple of hours after U.S. jobs data will be released. From today's calendar, we're going to take a brief look. Quite a number of releases seen for today. European PMIs, some of them are already released. We don't have the update, but I will briefly update you now. The first one was from Germany. October manufacturing PMI that was forecasted at 45.7, came out at, if you're doing just a minute, I do apologize, it hasn't been released yet. Actually, none of them released. I do apologize, I was mixed up with the time. Manufacturing PMIs from Germany, Spain, Italy, and the Eurozone 1. Quite disappointing figures seen on the forecast. The German one is forecasted at 45.7, well below September's 47.4. Spanish at 44 versus September 44.5. Italian 45.5 compared to 45.7, and the Eurozone's manufacturing PMI is expected, according to the forecast, to stay unchanged at 45.3. All European countries are showing their PMIs, manufacturing PMIs, well below the breakpoint at 50, showing that economies on their own and the overall Eurozone economy is still contracting, as any move below 50 breakpoints shows contraction, and on the other side, the break above shows growth. UK's construction PMI is due at 9:30 GMT. October's release forecast 49.1 compared to 49.5 in month of September. And then batch of data from America, our key releases. First, Canada starts at the same time at 12:30 GMT. Unemployment rate is expected to stay unchanged at 7.4%, while the US, as we mentioned already, non-farm payrolls are forecasted at 125,000 new jobs compared to 114,000 jobs in the month of September. Unemployment rate, as we mentioned, is forecasted to tick higher to 7.9% compared to 7.8%, and basically these are the key releases, and we will be focusing them, as most of investors are now in the sitting and waiting mode for a release of US data. As said, a positive release, and at least according to the forecasts, would be another a good signal for the recovery of US economy, as yesterday's ADP private sector jobs data came better than expected, and if you remember, this is one of the important indicators that sometimes gives a good indication of a possible release of US jobs data. So we believe that a positive tone will continue today, and show some positive releases compared to the better than the previous month ones. From the markets and the technical outlook that we are going to take a look now, we're starting with the euro dollar as always. Basically, the pair has fully erased the near-term recovery action from 128.85 higher base that peaked at 113.19 2 days ago, and the subsequent slide lower dipped as low as 128.86, basically testing the higher base at 128.85 zone. Seeing the more potential again towards the downside, as basically the pair failed to sustain recovery after retracing approximately 50% of initial decline from 131.38 down to 128.81. Asset focus turns lower. 4-hour indicators are now on the descending mode below their midlines as the price action moves back into the bear channel of 131.38. Currently, the losses were contained at levels just the previous base, and this is actually offering quite good support at this point with the further hesitation, probably not for sure, but further hesitation could be triggered by oversold, overextended hourly indicators. As the stochastic is already starting to point higher, we might see some consolidation. I would say rather consolidation than any stronger action until we see the release of today's U.S. jobs data. Initial barrier is at approximately 129.25 zone, then 129.50. Basically, to show any stronger improvement, we need to see the regain of minimum 126, pardon, 129.70, 129.80. This is the these are the tops of yesterday. That will signal some stronger recovery and avert immediate downside risk. Of course, a break above 129.80, 130.00 will also signal a double bottom formation of a double bottom pattern. That would be quite a bullish signal. Otherwise, loss of 128.85 as seen favored according to the current structure on the near-term studies sees a fresh extension lower and the possible test of another key support and strong support zone at 128.30, 128.00, 200 days moving average and double bottom at of 1st and 10th, 11th of October, 128.00, 128.25, along with the lower Bollinger Band of on the daily chart, 20 days Bollinger lower Bollinger Band on the daily chart. I do apologize. As well as the pair, as the pair loses also the main bull trend line drawn of 120.42 at currently standing at 129.35, as that more focus is seen towards the downside. However, larger picture as shown on the daily chart shows the pair still within the range and in the sideways mode. Since double failure occurred on the upside, 131.70 and 131.38, now risk is turning towards the downside, and the break below this near-term range base at 128 zone could be a signal of some stronger corrective action of larger 120.42 to 131.70, and with the break below 128.30, 128.00 to open Fibonacci support at 127.40. This is 38.2% retracement, equivalent also to the previous peak of 18th and 19th of June 2012 at 127.45. That will be seen as our next downside target in case of a break below 128. Conversely, as we mentioned already, break above 128.80, 130.00 is to provide the relief and keep the pair within the range. However, it will turn the near-term focus higher. A break above 130.20, the previous peak of 31st of October, is set to refocus upside barriers. Static resistances at 130.40 is the 61.8% retracement, and 130.82, the previous peak of 22nd of October, seen on the break. The British pound has retraced approximately 50% of slightly more than 50% of the latest stop leg from 160.05 that peaked at 161.74, just short of our next upside target at 161.78, peak of 17th of October, a break of which is basically required to turn the near-term focus higher. However, according to, I do apologize, according to the situation on the 4-hour chart where the studies are still in the positive territory, the latest pullback could be seen as corrective, as dips were so far contained at by 55 days exponential moving average and the bull trend line of 160.05. That keeps some positive tone and bullish structure still in play. Bullish structure of 159.11 low of 23rd of October. But as said, fresh. This is seen as a good reversal point, but a strength above 161 is seen turning focus towards the upside levels, but break above 161.74 and 161.78 with interim barrier of 161.42, 25th of October high, pardon, is required to resume the bulls of 159.11 and the open next targets at 162.00, 162.16. Rather flat and neutral situation is seen on the daily studies as MACD moves around in the very narrow range around the 0 point, similar to the 14 days momentum, still keeping the upside in a way out of reach. Break above 161.74, 78 is required to confirm the higher base, higher low at 159.11 and open way for a possible extension up towards through 162, 162.16 towards key barrier at 163.08, peak of 21st of September 2012. Of course, from the other side, the failure to clear and regain the 161.74, 78 tops and the further extension lower might be initial signal of forming a double top or even triple top pattern with a loss of 160.0. Basically, the break below the current support at 160.74 doesn't see any stronger obstacle on the way towards 160.00, 160.05 low of 29th of October, and that could be quite risky in case of losing 160.74. That will be a signal of double top formation. That will be quite a bearish indication, and will focus immediately 160.00. As said, conversely, break above these two levels, 162 and 162.16. On dollar yen, positive sentiment continues to push the pair higher. As you can see on the daily chart, the price is in the steady uptrend of 77.12. This is the lowest point posted on 13th of September 2012. A steady recovery reached so far 80.37. Back to the lower time frames, the price action so far reached 80.34. Just few ticks of 80.37, previous peak of 26th of October. With the hourly studies already in the overbought territory, seeing a possibility of some hesitation at this level. However, a positive tone that dominates on the 4-hour chart still sees room for a further extension higher, but again, the gains might be limited as also the 4-hour RSI, despite pointing higher and holding above 7 days moving average, still it's approaching the overbought territory, and this could signal near-term pause in the current gains. Break above 80.37 is to open the next barriers, 80.65, peak of 25th of June, as well as 50% retracement of a larger down move from 84.17 to 77.12, and then comes 81.00 as around figure and psychological resistance. On the downside, 80.00 as previous strong resistance and psychological barrier now acts as initial support, and the interim support is 80.13, previous peaks of previous peak of 30th of October, with 80.00 coming next, and this is also reinforced by ascending hourly 55 days moving average. Ideally, any dips should be contained at this point, and to keep the immediate bulls in play for a test of 80.37 and extension towards 80.65 and 81.00 on a break. Conversely, break below 80.00 could signal further delay and deeper corrective dips. 79.90 and 79.70 are seen as static supports on the downside. Basically, break below 79.70 could be quite risky, as would put near-term bulls on hold, and actually could also risk the formation of a double top that will be confirmed on the break below 79.27, 30th of October low. And finally, from currencies, dollar Swiss, quite a positive tone currently seen on the latest bounce from 92.75 2 days ago low, where the dips reversal of upside failure at 93.85 found good support. Fresh strength through fresh strength that emerged through above the 4-hour Ichimoku cloud is now approaching our key barrier at 93.85. This is a 200 days moving average, and 94.00 as round figure resistance. Also, we have the descending daily 55 days moving average. According to the daily studies, that indicators are pointing higher, but still in the negative territory, and the descending 55 days moving average that is threatening of that cross, in case of crossing below 200 days moving average, would be seen as additional pressure. 93.85, 94 is seen as a quite strong barrier, and any failure here would signal further range trading, as basically the pair is entrenched since mid of September within 92 and 94.30 range, with the rather sideways movement seen within this approximately 200 pips movements. Break above 94, 94, 30, 36 double top would be seen a good bullish signal for a possible stronger recovery. Of course, it will signal a breakout of the congestion and signal stronger corrective action of the larger 99.70 to 92.13 descent. Failure under 93.85 and 94.00 would, I said again, risk further sideways movement as shown on the daily chart, and basically would risk return down to initial support 93.00 and then 92.75. That will turn the near loss of which would turn the near-term focus higher. Again, release of today's US jobs data will give us some more clear picture of the current direction of the markets. Reminder that dollar is quite well supported with yesterday's and the recent positive and better than expected US economic indicators releases. And finally, we are going to take a look at commodities. As said, gold is losing traction following a false break, I would say, at this point above our initial barrier at 17.20. That was seen as a trigger for a further extension higher. 2 days ago, the peak was at 17.26 approximately, with the brief consolidation seen before the fresh attempt that higher that was basically capped at the same level, and subsequent sharp reversal. I would say at this point more technical selling was seen on this point, with the US non-farm payrolls data being in the main focus now for the gold traders. But anyway, the near-term focus now turns higher as this latest move quite strongly weakens the hourly structure with indicators deep in the oversold territory, with some initial signals of a possible bounce higher seen on the stochastic pointing higher, and the RSI slightly bouncing off the oversold barrier line, with the approximately 17.11 seen so far off the recent low posted early this morning at 17.06. But still the focus remains at the downside as the pair still hold, the price still holds below the initial dynamic barrier of 10 days exponential moving average, currently at approximately 17.11, and the bearish crossing of 10 days over 55 and 20 days over 55 days moving averages at approximately 17.15 zone keeps the more pressure towards the downside. Main risk would be seen on a break below 1700 base. That will signal further extension of the descent of 1795 fresh yearly peak posted on 5th of October 2012. As the price also returns below the main bear trend line of 1720, broken main bear trend line of 1795 peak. Test of 1705 level has been seen already, with main risk seen at 1700 and the 1698 recent lows that might trigger further corrective action of the larger uplift from 1590 that peaked at 1795, with the 1693 seen as the next target. It's a 50% retracement ahead of more significant supports, cluster of supports within 1660 and 1670 zone, where we have a 90 days moving average 61.8% retracement, and 200 days moving average currently at 1663. As said, daily structure is still holding a negative tone, and the latest movements above 1700 are still seen as rather consolidative action than any correction, as 55 days moving average still keeps the upside limited at this point, and unless we see the break above 1726, 1730 seen as a break, near-term break point, more focus will be seen towards the downside. Clearance of 1726 recent peaks and the 1730 break point to open immediate target at 1736, 38.2% retracement of 1795 to 1698 down leg. And finally, the crude oil. Let's first take a look on the trend. On the 4-hour chart, the uptrend is now fading, as ADX indicator is still in the positive territory, but pointing lower, seeing the trend is losing traction. On the hourly chart, the bears are already taking control following the latest pullback of 87.37, the peak of yesterday in late afternoon hours, following the release of disappointing US crude stock inventories, with the slide below 87 currently testing a 55 days hourly 55 days moving average at 86.46. Daily trend still shows the bears fully in control on the latest down move from 100.72, 14th of September peak, as the third wave is now underway of 172. Loss of important supports at 87.70 and 87.00 has so far seen 85 zone tested, with a brief spike lower to 84.67, still keeping the downside protected with the current corrective action seen of 84.67. I would say at this point is still consolidative rather than corrective, as the gains were capped by descending 55 days exponential moving average slightly above, a slight break above here, and did not result in any stronger recovery. And basically the price stayed short of our initial barriers at 87.69, low of 3rd of October 2012, and the 80.00 psychological round figure resistance, also 38.2% Fibonacci retracement of down leg from 93.47 to 84.67. Currently, as shown on the 4-hour chart, the price is entrenched between 20 days moving average at 86.32 and the 55 days one at 87.02, with the 4-hour structure I would say rather negative tone, as RSI is already below their 7 days moving average, and the MACD is slightly above the midline, while the sideways movement seen on the momentum at 22 days momentum and stochastic already pointing lower. Also ROC of 14 momentum is breaking below its 14 days 14 days momentum is already breaking below its 7 days moving average. We have, I would say at this point, more near-term bearish signals. Break below 86.00 is to confirm the near-term weakness, and probably to again refocus levels at good support and the base at 85 zone. On the daily structure, as said, the negative tone that dominates, with all indicators in the negative territory, sees again more potential towards the downside, and our next target in case of losing 85 would be 83.64, 10th of July low, and the projected extension of the third wave from 93.50 at approximately 80.50. That was all from me today. Please, now your turn to raise any question. If you have any question, please, you can type it and submit it to me now. Thank you all. It seems that we have no questions for today's session. Anyway, any question or any suggestion could be also submitted to our email as shown on the chart, analysis@windsorbrokers.com. I'll be glad to help and assist in any case you have, or any issue, any question, any suggestion from your side, of course, for a further improvement of our services, as this is designed for you. Keep an eye on the markets, especially on today's U.S. jobs data release, as we might see some action late in the afternoon. Of course, I wish you a nice Friday and good and successful and profitable trading, as well as good and relaxing weekend. Good luck.